So in these next few chapters, chapters 9 through 12 from the text, this is what we will talk about. In chapter 9, you will read about the capital markets in general and their role in financing. In particular, you will read about the bond and stock markets, and I encourage you to read that. I will not discuss that in class, but I would expect you to read that. It's fairly simple. What we'll talk about next in our discussion in class is going to be this component, which is calculating the components of capital, the cost of capital, or sometimes called the hurdle rate for a firm, which is like the minimum rate of return that any new investment needs to be able to provide in order for acceptance by the firm. And it also happens to be the firm's cost of capital. So in other words, so far we've assumed that the discount rate was given to us, and now we're going to find out what is the minimum discount rate that the firm would need to assume in order to make something sustainable. That's what we'll do in chapter 10. And then chapters 11 and 12 will talk about capital structure, what determines the role of, what's better, debt, equity, those kinds of things. Okay, so with that, let's talk about the cost of capital for a firm, as I said before. The best way to think about this is, first off, when you talk about cost of capital, again, remember what we're doing here is calculating the discount rate. The discount rate for the firm is the minimum hurdle rate that they have to meet in order to be able to invest in a project. In order to invest in a project, they need to raise capital. And in order to be able to satisfy the people that provide the capital, they need to give them a rate of return. So when we think about capital, we think about what are the sources of capital. One, there's debt capital coming from the debt holders, the bond holders. And then there is the equity capital coming from the preferred stockholders or the common stockholders. So broadly speaking, you can think about these as your components of capital. And each of them comes with an associated cost. And so in that sense, the cost of capital for a firm is nothing but the average of the cost of debt and the cost of equity. Or graphically, you can think about it as there's capital that comes from debt capital, preferred equity, or common equity. Each of these components, debt, preferred equity, common equity, has a cost associated with it. There's a cost of debt, there's a cost of preferred equity, there's a cost of common equity. But realistically, what is that cost? The cost of debt to the firm is what the investor or the bondholder, in this case, the person who provides the debt, who lends to the firm, what do they expect to receive as a rate of return in order for them to provide this debt capital. That's their rate of return, but it's the firm's cost. Similarly, the equity holder, the preferred equity holder, what do they expect to receive by way of a rate of return? That's going to be the firm's cost of equity. And the same is true for common equity. So once we know these three components, then we average these three to get the cost of capital. But we don't just take a simple average, we look at how much of the firm's capital comes from debt. So, and then similarly preferred equity and common equity, and then we weight each of these cost of debt, cost of preferred, and cost of common by the proportion of debt, proportion of equity, and proportion of common equity to give us the weighted average cost of capital. Okay, so let's take an example. Let's say there's a company, startup company that needs $1 million today. That's the total capital they need. They're going to raise the $1 million in three ways. One is raise $200,000 through the issuance of a bond or debt financing, $100,000 through preferred stock, preferred shares, and the remaining 70%, $700,000 through the issuance of common shares. So in terms of weights, debt is going to be 20%, preferred equity is going to be 10%, and common shares, common equity is going to be the remaining 70%. So that's what we have here is the share of debt, or the weight, W, weight on debt is 20%. The weight on preferred equity, just the notation for that, is 10%. The weight on common equity, W subscript E, is 70%. Let's also assume that we know that the bonds are issued with an interest rate of 5%. So the bondholders expect a 5% rate of return. The preferred stockholders expect a 7% dividend, and the common stockholders expect a 15% return. And as you can see, these numbers increase with from bonds to preferred to common equity. The reason being, this is least risky. This is slightly more, but not as high risk as equity. So the higher the risk, the higher the required rate of return. And so one would think that really the cost, the weighted average cost of capital, WACC, weighted average cost of capital to this firm is a weighted average of the 5% cost of debt, 7% cost of preferred equity, and 15% cost of common equity. So you weight all these by their proportions and you get the weighted average cost of capital. Yes, but not quite. And the reason for that is interest. When the firm pays 5% as an interest, it really does not pay that 5%. It pays less than that because there's a tax deduction on that interest. 35% of the interest component, you avoid taxes on the interest component of your debt and save taxes by having interest. And so although it pays investors, the bondholders, a 5% rate of return, its cost of debt is slightly lower than that. Okay, so that's what this next example is about, is to show you that the cost of debt is really lower than the return on debt to the debt holder. Okay, so this example, assume there is first situation is the firm has debt. Second situation, the firm has no debt. Okay, revenues, cost of goods sold, the gross margin, which is simply the difference between revenues and cost of goods, SG&A, and we've seen all this before, the net margin, depreciation, EBIT, interest. Now in this case, they're paying 5%. Remember, they're paying 5% on 200,000 from the previous slide here. They're paying 5% interest on $200,000 in bonds. So that's $10,000, and that's what appears here. Okay, so that's interest. And then as a result of that, the earnings before tax, the taxes, and so on. And if you look down here, what happens? You come down to net income. It's about 91,000 here. Then they pay preferred dividends of 7,000. Again, where did the 7,000 come from? It's coming from the 7% dividend on 100,000 preferred shares. Okay, and so as after paying off that preferred dividend, the earnings available to the common stockholders is going to be the 91 net income minus the 7,000 in preferred dividends. Okay, now if you look at the total earnings that go out to all the investors, there's preferred dividends to the preferred stockholders, there's earnings to the common stockholders, and what do the debt holders receive? They receive this interest payment, right? So that's, if you add up the preferred stockholders' earnings, the common stockholders, and the debt holders, that's a total of 94,000. If you did this without debt, let's say the firm did not have any debt, so there's no interest here, and they raised capital through some other way. They raised capital through common equity and preferred equity. So preferred equity got this, and common equity had to pay for the remainder. Now if you do the same calculation, what do you see? You see that the total income generated to all investors is 90,500. It's less than the total income generated when the firm has debt. It's less by how much? By 3,500. Okay. In other words, while the firm is paying out $10,000 in interest, it is saving $3,500 in taxes here, right? If you look at the taxes here, they're 49,000, they're 52,500. The difference is 3,500. They're paying 3,500 less here, which is showing up as more income, $3,500 more to the investors. And so as a result of that, we say that their cost of debt is not 10,000, but it's less because of the savings on taxes by 3,500. So the effective cost of debt is only 6,500, which if you look at it as 6,500 on $200,000 in debt turns to a rate of cost of debt of about 3.25%. And as a result of that, the cost of debt is taken to be the return on debt, KD, which is the yield to maturity or the interest rate on debt, times 1 minus the company's tax rate. You can also use interest over long-term debt as to indicate the interest rate, and generally interest is the interest on the income statement. Long-term debt is the sum of all components of long-term debt on the balance sheet, and this tax rate TC is the corporate tax rate, is the total taxes paid by the firm over the earnings before taxes. And in this in the case of the firm, in the previous example, KD times 1 minus TC was equal to, it was paying a 5% return on debt, but because its tax rate was, what was the tax rate, was 35%, the effective rate of the cost of debt was 0.65 or equal to 0.0325 or 3.25% was their effective cost of debt. Okay, so that's the cost of debt. The next couple of modules I'll talk about the cost of equity.